We're going to talk about what we call residual income. And so residual income is it's the excess of income from operations over what is the minimum required by me. So if my minimal acceptable income is $100,000, then anything over $100,000 is what I call my residual income. And so in order to have a residual income, I have to have what we call a minimal rate. It has to be set by management. So here's my income from operations minus what my minimal acceptable income is, and anything over that becomes residual income. So here are my three different divisions. This is the same company. If you remember, this was the income from operations we were showing before. And most of the time, it says the minimal acceptable income from operations as a percent of invested assets. So a lot of times companies say, hey, we will only accept 10% as 10% is our minimum. So we don't want anything less than 10%. So in order to figure out what my minimum acceptable income is, I'm going to take 10% of my invested assets. This percent is set. This is the minimal percent rate. This is the minimal dollar amount. And it's often a percent of my invested assets. So I'm going to say this again. This is the minimal acceptable income from operations as a percent. And here they are as dollars. So 70,000 is my income from operations. My minimal acceptable was 10% of invested assets, 35,000. So my residual income for this division is 35,000. This is 14,000, and this is 25,000. So right away, if you look at these, you're going to say, hey, the Northern division is doing the best, Central is doing the worst, and Southern is in the middle. Okay, but we need to talk about why this particular information is so important. When I look at residual income, it measures both what the minimal acceptable rate of return is, the invested assets, and the income from operations for each division. So now I'm looking at three different things. So the whole thing about managerial accounting is maximizing income from operations over and above whatever my minimum is set. So let me show you a little example. Here are my, this is for just the Northern division. Remember, it's at 20%. My minimum is 10%, but I'm looking at a new project that I'm considering that's going to give me 14%. Now, if I look at this new project, I can either reject it or accept it. If I decide to reject it, again, if I decide to reject it, I'm rejecting it just by looking at 14%, saying, hey, it's less than the 20%. But if I decide to accept it, it's actually going to increase my residual income. It'll actually increase my residual income. So just want you to talk about that a little bit. This is probably the hardest concept to understand in here is my residual income. Okay, next I'm going to talk just briefly about what we call the balanced scorecard. Okay, the balanced scorecard is a complete set of many different performance measures for each company. I don't just look at one thing. I just don't look at manufacturing performance. I just don't look at performance for one department. I have to look at multiple things. And so it's kind of like a little flow chart that I look at what my internal processes are, how well are they doing financially, how's my customer service, and how's my innovation and learning. So this is called a balanced scorecard where I'm actually looking at multiple things all at the same time. And remember, this chapter is about relationships and how they work with each other. So we need to look at, we're going to look at the overall financial performance. How can I improve it? Because that's always my goal. And so here's some measures. Here's some things I can actually measure. We'll start under innovation and learning. We're talking about the number of new products, new patents, number of training hours, employee turnover. Is my employee turnover high? Well, maybe my training and learning process is bad. So if I look at these measures or these performance measures under here, I can actually understand that maybe something needs to be changed. Customer service. How many repeat customers do I have? What's my customer satisfaction? How many customer complaints? So all of these are performance measures I look at to understand, is this doing well? And the same thing under, say, financials and internal process. So all of this is just understanding that one or two things, just looking at revenues or cost or rate of return or return on investments or residual income, these only matter as an individual, but you're going to look at them also as an overall balanced scorecard for the complete company. That concludes all of my Chapter 23 lectures. There's still a little bit more on the PowerPoint. You're welcome to look at it on your own, but these are the major components that you'll see in your homework and or tests.